B. Vines, welcome to Property Insights, mate.
Thank you for having me.
You're from Ray White Commercial, Western Sydney. I guess that says it all. You do commercial in Western Sydney. Where's Western Sydney start?
West of Bondi Beach. No. Pretty much sort of, west of the Anzac Bridge, through the inner west, back out to Penrith, back down to Campbelltown, and then probably over to Macquarie Park.
Right. And so I'm hearing lots of stories around the world, or in relation to around the world, particularly in the US, that commercial valuations are being challenged. Probably not in every single category, but commercial valuations are being challenged. Have you got some commentary on that? Because I was reading that in The Economist only last week.
Look, I think the only place that they wouldn't be challenged is where there's no transactions to back up the valuation. The fact that interest rates have gone up, people want a greater return on their money. And so where we are still seeing very low yields, we need to look further into those transactions to work out why they are transacting at the levels they are. Like the house in Mossman, that was a Childcare that transacted for 2.75%. We need to look further into those sales. But I think as a general rule, if you're managing money, you need a return on your investment, so you need to be ahead of where the cash rate is.
So explain that a little bit more, because most people don't understand how commercial properties are priced or valued as opposed to pricing. So explain the relativity between, say, the cash rate, which is, we're at 3.85 right now, but relative to a cash rate, how does that impact the value of a commercial property?
Well, people are investing for a return, whether that be a self-managed super fund or Charter Hall on behalf of their investors. They need a return on their money. It's much more the requirement on the return on money is greater when you're managing money on other people's behalf, because you need to borrow money, you need to make a clip yourself, and you need to pay the investors something as well. So as the cash rate moves up, the greater that yields need to become so that people can get a return on their money. That's what we're buying. We're buying a financial investment product. And so even if it's a mum and dad buying for their super fund, they need to get a return which, hopefully would be better than the no risk cash rate. But we are still seeing very low returns in certain parts of the market. But I think there's transactions that are going to occur in the next 6 weeks, which will reset the investment market, particularly in the Sydney CBD and further afield.
Yeah, so I always sort of looked at it, and you touched on the word risk-free. I've always looked at it like this. If I'm going to buy a commercial property, start again. If I've got $1 million and I'm going to invest that $1 million, and if the risk-free return, that is the money the Reserve Bank determines is the cash rate, if the risk-free return is 3.85, which it currently is, and risk-free basically means the lowest risk and best interest rate in the market and optimised position. But the risk-free rate's 3.85. I might as well put my money on deposit with the bank and get, 4.5%, because that's pretty much risk-free anyway, and I don't have to do anything. And the banks are guaranteed by the government. They're not really, but there's an implied guarantee. So I'm always going to get my money back, and plus my interest rate. I might as well do that instead of investing into a commercial property wherever in Australia, because unless that commercial property returns me something to seduce me into investing in it. So it has to be something greater than 3.85%. And then also, there's got to be a little bit of upside too. Maybe there's a bit of capital growth in it, perhaps.
Absolutely.
So but that's the way I look at it.
In a market with volatility, though, I think that the risk for downside is there. As well. And so it wasn't there previously, and so people would buy whatever they could just to get a return. Whereas now it's right. Who's my tenant? What rent are they paying? Are they in an industry which is fundamentally solid, or could I have a vacancy sitting here? And retail's perhaps one of those sectors where things have changed a bit. Industrial's really benefited from that withdrawal of the traditional bricks and mortar retail store. So I think people are just that much more cautious, and when there is potential for greater downside in the volatility that we're in at the moment, we do find particularly investors sitting on their hands or going for something which is a lot less risky.
Yeah, so like in terms of risk, let's say I say to myself, okay, well, someone's offering to sell me for $1 million a property in Western Sydney, and the return they're offering me is 5%. So it looks pretty attractive because I can only get 4.2 from the bank. And it's, what are the other factors I need to bake into my decision-making process around that investment at 5% compared to, say, the risk-free investment at 3.85%? What are the things I need to bake in? You just mentioned tenants and things like that.
And the thing that we find is that the people who are spending $1 million sometimes aren't as seasoned as the people who are spending.
I said to me, I could be talking about 5, 10, 20. I mean, just talk principles now.
You want to look at your tenant. You want to look at who.
What does that mean?
I mean,
what type of tenant I got?
Exactly. So what type? I mean, if Video Easy, when people bought a Video Easy at 4% or whatever, it's like Video Easy's on the outward trend. You need to look at what sort of business they have. Stand outside the shop, see how they trade. Are they selling product? Is it a related entity of the seller? Have they stitched up a lease and you're going to buy it, and then 6 months later the tenant's going to leave? How long's left on the lease? Are they paying market rent? What are the rent increases? It's quite you can find yourself in a position where you might be stuck with a vacant property. You've borrowed at a certain percentage based on the return, and then guess what? You can't find a tenant to fill it up, or you need to pay a large incentive then to lease it out again. So it's really, you need to do your due diligence effectively on what you're buying.
I think that's the important point too there. That's that due diligence piece. Does your firm, for example, offer people a pro forma due diligence sheet, like sort of, where does someone find this information? Like, let's say I'm a buyer and I'm talking to the vendor's agent, so you're not going to tell me.
No.
You're not my agent, you're the vendor's agent. Where do I find out what are the things I need to do my due diligence on? Like you just said, make sure the vendor, the person who's selling me the property, isn't somehow related to the tenant, because it could be a stitch up. 2, where do I find out? And I'd like to know in what order these things get done, or what's most important. But should I be, if it's currently paying 5% return, if there's only 1 year left on the lease, but the tenant's got an option for another 10 years, I mean, is that good or bad? I mean, where do I find this stuff out?
Yeah. Look, I haven't. I'm sure the internet's full of resources for investors. The other thing you can do is you can work with a buyer's agent. Again, a lot of the people who we work with, for a living, they invest professionally. And so they're not necessarily in need of those services. But, there's buyer's agent firms out there, like there's all sorts of ones that will come in and run due diligence on an asset for you, just to make sure that you are getting the right advice.
What would you look for?
I always look to see whether the rent is in line with market. So I'll go and look across the market and work out whether the rent is elevated. Again, some of these things, people buy vacant properties, they put in a fancy tenant, a name brand, it's all polished, they pay a massive rent, and then they sell it on a very tight return. And the premium that you're paying for that brand is quite significant. You're paying that because typically they're a solid tenant and they have the ability to repay the money. You're dealing with a corporate opposite you. But the challenge is not while they're in there. The challenge is if they don't perform well and they decide to leave, or you find yourself with a vacant premises, the value of your asset is tied to the value of the rent that you're paying, or that somebody's paying you rather, because it's based on a yield. So I always look and see, is the tenant trading well? Are they paying market rent? And how long the lease is there are a couple of...
The longer the lease, the better?
Yes, absolutely. If there's only a year left on the lease, I want to be checking how soon the tenant needs to give me notice that they're wanting to take up the option.
Would you go and see the tenant?
I
I'm going to buy this place.
Absolutely. The people who I find are the most successful in terms of managing a property portfolio are often the owners, and they have personal relationships with their tenants. And when times are good, they all win. And when times are tough, the owners will often go in there and try and sort things out with the tenant, because the value of their premises is aligned to how well that tenant does and that tenant paying rent. So you need to have your finger on the pulse. So absolutely, yes, I would go in and talk to them.
Right.
Yeah.
So, okay, we've established then, we've done our due diligence, and the return on the property is 5% per annum.
Yeah. What are the increases? That's a good one to check as well.
Yeah, and let's say the increases are CPI, which is pretty good at the moment.
Yeah, that'd be very...
but they won't last forever. So, but they're, inflationary based or CPI based. How do I then work out if the return is 5%, and that means that let's say the tenant's paying me $100,000 a year, or paying the landlord, the current vendor, $100,000 a year rent, and the return is 5%. How do I work out what the price is?
You basically take the rent, you divide it by the percentage that you're looking to achieve, and you'll get the purchase price. So,
So if it's a 5% return, maybe a way I do it mathematically anyway is I divide 5 into 100. That goes 20. And I multiply 20 by the rent. And that gives me 2 million. So in that example, a property that's returning, well, that was 200,000. Let's say I said it was 100,000. So let's start again. So I take I divide 5% return. I divide that into 100. It gives me 20 times. So I now got a multiplier of 20, and I multiply that 20 by the 100,000. Yeah, that gives me 2 million. That's right. So the property's now worth $2 million. So a property that should be yielding 5%, because everyone in the area is yielding 5%, and based on the risk of the tenant and all that other stuff, length of the lease and all the CPIs with all the increases, whether the CPI or some other number, based on all that, it seems like the market wants to give that property yield of 5% on the risk, etc. Divide that into 100. I get 20. 20 times the rent is 2 million. That means I should pay $2 million for that property. But it's not just. It just doesn't stop there, does it? Because there might be land tax involved. So what are the deductions from the $100,000 a year rent that I should do?
Land tax is a massive one at the moment. I mean, land tax in some locations has gone up 300%. So you know what? Your investment doesn't look so good anymore unless the tenant's paying it.
And that's rare.
Unless
it's a big tenant.
Or you're exempt, like childcare. So we talk, one of the reasons people are investing in childcare, boarding houses, because you're land tax exempt. Okay, so that's a massive cost.
How do you work out the definition of a boarding house?
It has to have been approved through the boarding house SEP, and then the rents that are charged are meant to be 70% to that of market. So it's meant to be an affordable housing product,
right.
As opposed to the traditional ones that were, The other thing you need to look at is obviously, any other rates that are associated with owning the property. So council rates, land tax, we said, fire audit, insurance, agents' costs. So what we'll find is that when properties like this are advertised, you need to work out what the net rent is as opposed to the gross rent. So what am I going to put in my pocket at the end of the day after all of my expenses? So you just
might not be much on that $100,000 example, because if it's
going down a lot at the moment. I mean, land tax has smashed people this year hugely.
So just on that, if the property's sort of 5% yield, because the land tax doesn't do the same calculation. The land tax office doesn't do the same calculation. They
don't care. they look at the land values over the last 3 years.
So they don't do the calculation we just did. They don't take, hang on that property, it's $100,000 a year. It was not worth 2 million because you've got all these different taxes and things like that. It's probably only netting 50, and if it's netting 50, that would be
don't do it.
That would make you're making a mistake, because by the time you pay your land tax on the 2 million, you're negative. So if that's the case, are you finding? Is there any difficulty at the lower end of the market? And just let's put aside those land tax exempt businesses, those land tax exempt uses that you're talking about, like childcare, etc. Just put that aside for a sec. Is that having an impact on the commercial property values?
It has to. The same way that if the cost of money goes up, the yields grow. If you're getting less in your pocket, it affects the value. So yes, at the lower end of the market, though, we are also finding a lot of those groups. They're the ones who are the most susceptible to confidence, and they buy with confidence. And so when interest rates start to jack up, they tend to sit on their hands a little bit more. And so it's really in that smaller price point, sort of that, $1, $2, $3, $4 million price point, that there's a lot of people sitting on their hands at the minute, not knowing what to do. Buyers, absolutely, yes. Yeah.
That's interesting.
Yeah.
So let's just look at the your experience with the land tax exempt categories. There's lots of exemptions, but one of which is childcare. There's been a lot written about childcare lately.
Yeah.
What's the deal there? I mean, what are you guys doing out there at Ray White, out of the West Sydney?
Well, in terms of, we've sold probably between 10 and 15 DA-approved childcare sites in the last 9 months. And there's a whole industry of childcare operators whose businesses are absolutely thriving through government incentives for people to return back to work, double incomes coming through, and these people are looking to scale their business, and so they need to operate and have control of these centres. And as an investment product, it's been unbelievable because, you've got these massive long leases in there. You deal with one tenant and, you don't have land tax, and you just get this reoccurring income month after month. And so it's a much more vanilla, easy to understand asset class for many people. And it's been hugely popular. I mean, anything that has government subsidies to it, medical, people love, because it gives them that certainty around the covenant of the tenant.
So what's it take to make something a childcare centre? So are we talking about houses, or what are we talking about later?
Yeah.
How's it work?
Look, typically you'd be looking at sort of 1,500 to 2,000 square metres of land combined. So that, not in the east, you're not going to find two houses like that. But, as you go out west, pulling two houses together has been what people have done. And they've seen the yields that these things have been trading at. And so the operators have gone out and been developing their own centres, but also developers and investors have been going out pre-leasing and then selling selling to investors.
They get better returns than keeping it as a house, though?
Absolutely. Yeah, the returns on these things are massive. So say you've got 100 children, right? Somebody, depending on the area where you're in, somebody might pay you $5,000 per child per annum. So that's $500,000. You need to go and build this thing. So there's considerable cost in construction, which has also gone up in the cost.
Do you have to pull the house down?
Yes. Look, not always. We've sold old churches, we've sold old buildings that people convert, and there's enough land there where they can bring in parking and convert and do something like that. Typically, it can be easier just to start from scratch, though. These things are purpose built. They need clear span for the classrooms, and they get better efficiency starting from scratch. But often, they'll convert heritage articles into childcare where there's land on the side as well. Right,
and so it's a booming business, the childcare bit?
Yeah, absolutely. Absolutely it is. Like you think about, the population growth pushing out west, but again, the cost of living and the pressure on living, you need the second person in the family to be going out and working. Also, there's quite a bit of pressure on parents to have their children ready for kindy. So the whole preschool thing and having them sort of skilled up before they even get into school, there's a fair bit of pressure on them to do that. But also, in a world where we talk about mental health, having a couple of days probably away from the kids for either the mum or the dad, I think is a massive thing. Just having a bit of space to do whatever you need to do.
It's interesting that you've seen this popularity, sort of this popularity growth and a shift in the demographics about who uses childcare and why they want to use childcare. But it only works if the government continues to subsidise.
Heavily subsidise.
Yeah. So, and when you say heavily subsidised, is there a risk around that?
Whenever the government's involved with subsidising, I think, yes, there is a risk. But also, governments rolling back subsidies,
lose elections.
Yeah, that's right. And so particularly in a sector like that, which, we really need people out in the workforce. We have a massive skill shortage. We have a massive shortage of people willing to work. And so if we have to subsidise childcare to get people in there, then that's what they're going to continue to do, as well as bring in immigration.
Wow, that's a really interesting... I mean, that's a great place for us to stop there, Peter, but a great explanation of how yields work and how yields are increasing at the moment relative to the official interest rate, how risk works. Then specifically, one of the big risks is the land tax grab by state governments, which is just getting out of control. In New South Wales at least. And one way around that is make sure you sit in the exempt category. Is there any risk the government's going to take that exemption away, state government?
Whenever you rely on the government, there's always a risk.
Yeah.
Yeah.
Well, that's interesting. So, but maybe...
I mean, they might take negative gearing away as well.
Yeah.
There's all sorts of threats of, they might cap rentals in residential property.
Yeah.
So, I think there's always a risk of that when you start investing.
Yeah, that's very interesting. So... Well, it's a category worth looking at in the commercial space. I mean, commercial space, I think, generally is quite challenged at the moment because of land tax and therefore the reduction in the rents, passing rents, and therefore really a problem with getting a proper return, or at least being able to calculate it. And but there are exemptions around all this, and one of the prevailing exemptions is childcare. And I like your reference before about to affordable housing, or it doesn't mean backpackers, it means something else, doesn't it? Hostels, or what does it mean?
As in like the boarding houses or co-living? Yeah. I think that is probably one of the best asset classes moving into the future, just given the lack of affordability and the amount of immagration that we're going to have.
And the lack of availability.
The pressure on rentals, what a good product to own. And we're not talking about the old slumlord kind of backpacker style. They're all single, individually contained, very nice apartments. If it's co-living, they might have common facilities which they can all benefit from. Even in the boarding houses, they do. But it's a very neat product. It's a studio apartment. Yeah. But the returns that they're spitting out are very strong. Yeah. And I think we'll continue to do that.
Very interesting. Peter Vines from Ray White Commercial, Western Sydney. Thanks very much. It's been great.
Thanks, Mark. Cheers.